morning to you and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group. They're out of Glastonbury, Connecticut. You can find them online at www.frplan, F as in financial, R as in resources, plan, frplan.com. And what I want you to write down and more importantly call is this number, because at the end of the show, the first 5 callers, oh my goodness, you're gonna get an assessment that's worth it's at least $2,500. You've got to. I'll let Mark explain that more towards the end of the show. He'll do a lot better job than I will, but it is very comprehensive, extremely thorough, and it's going to be probably one of the best phone calls that you have made for yourself, maybe even for your family. The phone number is 860-657-8380. Let me repeat that one more time. 860-657-8380. If you miss any of those points of contact, don't worry too much, because I'll repeat it at least a couple times before the show is over. Mark, good to see you. Good morning.
Good morning, Gary. Great to be here. How are you today?
It's we're just getting started here. It's early in the morning, but it's a weekend. It's a Saturday. I got some plans a little bit later on. What about you? Anything good this weekend?
Yeah, we got a couple things to do this morning. Got to get my car detailed and get that finalized. So
I thought you were doing that like a couple of weeks ago.
Yeah, and this guy is so good. You go back to him again, and he kind of just goes through some of it with a fine-tooth comb and reseals the spots that need some work, and he's just tremendous. And the car looks like mirrors,
like a ceramic
ceramic coating and everything, and unbelievable. Unfortunately, I ran over some industrial grease and stuck to the paint, and I'm afraid to take it off myself, so he's going to handle that. And then at night, I'm actually going to be going to Mohegan Sun, and I'm excited to see Billy Idol. Remember Billy Idol?
Oh, yes, Rebel Yell.
Yeah, Rebel Yell, and so it's going to be hot in the city tonight, Gary.
Yes, it will. I hope you won't be dancing with yourself, though.
No, absolutely not. I'll have someone with me, but we're also here to talk about Moni Moni. So we better, before we get anything, why don't we get our disclosures out of the way?
Yeah, let's do that. Go ahead.
All right. So the opinions expressed during this program are those of Mark Papa personally and not necessarily reflect the views or positions of Financial Resources Group, LLC. All investors involve risk, including the possibility of loss of principal. Nothing discussed in this program constitutes an offer to buy or sell any security or investment product. Past performance is not indicative of future results. Financial Resources Group, LLC is a state-registered investment advisor. Always consult with a qualified professional before making any investment decisions.
Very nice. Very nice. Wow. We can go. I want to talk about SpaceX. There's so many things I want to talk about. Folks, if you own a mutual fund, a 401k, an index fund, anything at all, the story that we're going to lead with today may already be in your portfolio, whether you picked it or not. So, what, last night, or I don't know, maybe it was this past
Tuesday.
It was Tuesday. I was going to say, I thought maybe it was the last couple of nights. SpaceX, ticker, SPCX. And it's been public since June, just recently. It reported its second quarter. And Mark, on paper, I mean, obviously, this looks like a blowout. Revenue of $7.81 billion against expectations of, what was it, 6.82. Adjusted EBITDA of 3.54 billion against an estimate of 2 billion. I mean, look at it all. You do the math. That's 77% above. They beat on the top line. They beat on the bottom line. And then what? What happened? You know, the stock fell more than 8% after hours. Wow.
Yeah, and, the whole story is in one sentence, Gary. I mean, they beat on everything that a company that controls the stock got, and they beat on everything, and then the stocks got sold anyway. And I want to be careful here, because I'm not here to tell our listeners to buy or sell the stock. It's either loved or hated. You're either a long-term bull or you hate it. There's no in between. But what's interesting enough here is I am a long-term bull on the company, and I think it'd be wise for people to wait for a proper entry point. But, I mean, the big picture here is this is a very great case study almost, because what's happening to SpaceX last night is the same question the market is now asking every single company tied to artificial intelligence. And that question is not, can you grow? It's how much money do you have to burn to grow? And, and when you get When do I get back? When do I see a return? When do I see a return on my investment? So, and so, it's interesting.
All right, let's take that apart, though. Start with what actually got reported, Mark.
Okay, so revenue nearly doubled year over year to $7.81 billion, which is a big number.
Yeah.
Adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, that nearly tripled to $3.54 billion. GAAP, which is GAAP, loss per share came in at 9 cents against an expected 29-cent loss, so better than expected. Net loss shrank to $541 million from more than $1 billion a year ago. Now, I just want to put a point out here that this company could be a lot more profitable if it wanted to be, but it's reinvesting its capital. This is exactly what Amazon did for well over almost 2 decades. When they first came public, they could have reported a profit. They reinvested their capital. Look at what happened to Amazon today. So I think there's a great parallel that we should all be learn about, a lesson. Everyone says Amazon doesn't earn any money, but guess what? They had a lot of revenue. They reinvested that revenue. They had very thin margins, and look at them now. Look at how huge they are. Mm-hmm. So SpaceX, and I see there's a great parallel for that. Maybe we can do another show on that. But
the stock went the other way, though.
Yeah, stocks did not do well, because Wall Street is looking to see, Wall Street is about show me the money right now with the AI trade. And the stock actually finished the regular session up 9.43% at the, so it did well. But then after the release hit the after hours and then the spin they gave on the conference call, it took back, some percentage points and went down. So, essentially the entire day's game was a race in an hour. And Gary, that tells you that the selling was not about the earnings. It's more about the outlook. It's about, it's about what was in the release and, what are the future profits going to look like for the company, which I think are going to be tremendous. But again, Wall Street analysts have a different take. I'm not sure they truly understand the company.
All right. Well, but before we get to that, help people understand what they're even looking at, because SpaceX isn't just one business, is it?
No, in fact, it isn't just, they're not just building rockets and they're not just launching satellites. This is, one of the, put it this way, economically, there's 3 different companies stapled together under one ticker. The first thing is you have a space, okay, which is why they call it SpaceX. That's the industrial, the industrial business. They build rockets and launch services. They're launching satellites. That was $962 million in the quarter, about 12% of revenue. Okay, so not a huge chunk of revenue, but 12% is 12%. Connectivity, that's Starlink. Now, satellite internet, it's sold by subscription. That was $4.29 billion and about 95% of revenue. So that's where a lot of their major growth is coming from, is in Starlink. And this is functionally a telecom company. And, Musk announced that he thinks he can overtake AT&T and all the other wireless companies as well with Starlink. So there's a huge competitive future there with this space. And then the third is AI data. And AI had a great quarter for them, but it's the AI data centers, cloud compute, and the Grok and X assets were $2.56 billion, or about 33% of revenue. And AI actually had some growth for the first time, and it's been struggling for a while. But that's actually good news for SpaceX in the long term, in my opinion.
Okay. Interesting.
Yeah, so when someone tells you you own a rocket company, what they actually own is a telecom business, a data center business, and a rocket business. And only one of those 3 is making money, unfortunately.
Ooh, which one?
Yeah, and that's Starlink, and it's okay. And it's not even close. Well, and we'll come back to that later.
All right, you mentioned EBITDA, right? The EBITDA. All right, so of you're talking about of the $3.54 billion. Explain to somebody who doesn't do this for a living, like yours truly. Right. I mean, what does that actually mean in layman's terms?
Yeah, and that's a great question. Earnings before interest, taxes, depreciation, and amortization. This is something that Charlie Munger, who was Warren Buffett's partner, absolutely had a better term for it, but he was not a big fan of people who were touting their EBITDA versus their actual earnings and free cash flow and long-term outlook of the stock. But this is a growth company, okay? That's, make no mistake about it, it's a speculative growth company, which again, in honestly, it's the most important thing in the whole report, because what it's saying is adjusted means the company has also removed some other items and it considers non-recurring or non-cash. It's legitimate. It's a legitimate, widely used measure. It's not fake, but it's a measure of profit before you can count several very real costs.
All right. So what got taken out here?
All right. In this quarter, $2.85 billion in depreciation and amortization, $831 million in stock-based compensation. So the employees get paid in stock, so the stock performs. Obviously, you make more money that year. Versus cash bonuses, they get stock bonuses. You get granted stock at 100, and the stock goes to 200, and you're making a nice bonus. So it incentivizes the employees. Depreciation and stock comp, and then you have $3.68 billion, that was $3.68 billion, which is more than the entire adjusted EBITDA figure of $3.54 billion. So I think that's what's confusing Wall Street as well.
So the things they excluded are actually bigger than the profit they reported.
Yeah, and then this is their first quarter, so I have never seen an IPO company that just IPOs come out. This is a great quarter for them, but come out and then Wall Street loved what they saw. I just haven't seen it. They're newly public. It's going to take some time for them to digest, but, the revenues are there. You can always control expenses. You can't create more revenue. You can create more revenue, but if your revenues are down, you're in trouble, I don't see that. I don't see this company having much of a revenue problem in the future. I think it's going to be more of a CapEx and spending problem, which I don't think is going to be a problem because I happen to believe of all the hyperscalers, I think Elon probably has probably the most cost-effective way to deliver AI with the space, the data centers he's going to build in space.
Now, some people would say depreciation is just an accounting entry, right? It's not real money going out the door this quarter.
And in some businesses, I would agree with half of them. If you own an office building, depreciation generally overstates your economic costs. Buildings last for decades, so commercial property can be depreciated over many, many years. But there's also the argument fails badly for this kind of company. When you buy a rocket, a satellite, or a server, that item doesn't last forever. Satellites deorbit, rockets get retired, and AI servers, the graphics processors inside the data center, which has been argued, how many years should those be written off? Is it 2, 3 years? Is it 3 years or 6 years? Some companies are saying they have longer lives, so that's actually inflating their profits. But those are a very short, useful life. So they get out competed by the next generation in a few years, not 30 like a building. So it's quite interesting. So depreciation here isn't an accounting artifact. It's basically it's the income statement's way of telling you that this equipment is going to have to be bought again and soon. And if you ignore depreciation for 1 quarter, fine. But if you ignore it for 5 years while the company keeps buying satellites, chips, and data centers, you have to build yourself a completely unreliable picture of the future. So depreciation is the core of the economic model, and it isn't just a footnote to it.
You said Starlink is the one profitable piece. All right, so give me the numbers.
Well, connectivity revenue grew 66% to $4.29 billion. Operating profit was $1.6 billion, a margin close to 39%. I mean, that's a business I'd like to own. And this is genuinely an excellent business. So subscribers doubled to 12 million. And on the enterprise and government side, revenue grew, 108% to $1.81 billion, with Starshield holding a multi-year U.S. government contract reportedly worth over $6 billion.
So what's the catch here?
Well, 2 catches. This is first in the fine print. Your average revenue per user. That's ARPU. This is what they use for wireless kind of companies. It's called ARPU, which is average revenue per user. Fell 22%, which is not a good sign. Never good, but it could be a glitch, a blip, or say from it's $85 million a month last year to $66 a month now. Prices must be coming down. So they doubled the customer count, but each customer is worth about a fifth less. Right now, the subscriber growth is more than covering that decline. But arithmetic is arithmetic. So if the price per customer keeps falling, you need more and more new customers in every single quarter just to hold the same growth rate. So, just like anything in technology, the first flat screen TV came out was $40,000. And then, it goes back 5, 6, 7, 8, 10 years later. Right. Okay. You can buy that same thing on, whatever that Christmas or Thanksgiving rush they call it. What is that called?
Black Friday?
Black Friday for, $9.99. So, it's just what happens. It's what.
All right. You said there was 2 catches. What's the second catch?
The second catch is what Starlink's profit is being used for. And that's $1.6 billion in operating profit is essentially funding the losses everywhere else. AI and space, lost a combined $1.8 billion in the quarter. So Starlink isn't only creating value; it's absorbing, and masking some of the other losses from the rest of the enterprise. So a shareholder looking at the consolidated number never quite sees how good the telecom business is or how expensive everything is attached to it.
Yeah, and that's a pattern that you see elsewhere, isn't it?
Yeah, it's a defining pattern in this entire market cycle, Gary. I mean, one mature, highly profitable business subsidizing an enormous bet on something that hasn't proven its economics yet. So hold that thought, because that's exactly where we're going to be going in the second half of the show.
Well, and that gives me a timing to do this. Folks, you are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is the president of Financial Resources Group in Glastonbury. You can find him online at www.frplan. And you can call this number when the show is over. Be one of the first 5 callers, as a matter of fact. And 860-657-8380. And boy, I'm going to have him explain to you more towards the end of the show what he's got in store for you. All right, so let's start here. Let's do this AI segment, because I know, look, that was the big upside surprise in all this, wasn't it?
Yeah, I was even surprised, and give credit where credit is due. This is legitimately impressive. The AI segment revenue, which has been struggling, hit $2.56 billion in revenue. That's up 213% from just one prior year quarter and 240% year over year. So that's big growth. AI solutions and infrastructure alone went from $475 million to $2.19 billion in 3 months. So, I mean, we're using a lot of numbers here, so I don't want to bore people and confuse them, but they disclosed, an additional $14.1 billion contracted cloud services agreement sales. So nameplate computing capacity went from 1 gigawatt to 1.4, and with a target of roughly 2 gigawatts by the end of the year. So segment the EBITDA swing that we talked about from negative 600 to 9 million to positive 1.5 billion.
Ooh, this sounds like the bull case here, if I've ever heard it.
It is the bull case, and it's real. And this has stopped, being a science project. There's customers, there's contracts, there's revenue. And there's a question that the market asked last night, and the only question that matters is how much they have to spend if you get there.
Okay.
Right? How much you have to spend to get there. What is your burn rate going to be, and how much you have to spend?
So how much is it?
Well, the AI segment alone consumed about $15.83 billion of capital expenditure in the quarter to produce and then it only produced $2.56 billion in revenue. So it's early in the game.
Say that again here.
The segment, so AI, they spent $15.3 billion in capex in the quarter, and it only produced $2.56 billion in revenue. But if you think about that, Gary, if I put up $15 billion today, in the next quarter, or and it produced $2.65 billion in revenue, look at the forward-looking. My break even is not that far away, but they're going to be spending $15 billion a quarter for a while is the problem. But my break even potential with these revenue growths, it gets pushed out into the future, but it's definitely there at some point, as far as I'm concerned.
Well, and the positive EBITDA in that segment, the $1.15 billion. What about that?
Well, I mean, the same trick, same trick as the group level, Gary. The number includes a $1.89 billion depreciation, so there's a lot of numbers baked into there. So I don't want to get in there and maybe keep quoting all these numbers for folks, because that just sounds like
all right.
Boring.
So quickly then,
but the bottom line is, give or take. I mean, the real takeaway from this is, okay, I'm going to spend X, I'm going to get Y back, and when is that Y coming?
Let's go to the rocket side, because, listen, that's what most people think this company actually is. What do you got there?
Well, basically, I want to be fair to the company here. Spending heavily ahead of revenue is what building infrastructure looks like. The railroads did it. Telecoms did it in the 90s with fiber. The question isn't in cell towers. The question is rather legitimate, but it's also whether return on investment shows up over the full useful life of the equipment. And we don't know that for years, because nobody has yet lived through it, right? And we haven't been there. And what a full replacement cycle of this generation of AI hardware even looks like. So let's go to space revenue, Gary. That was pretty significant as well. It was $936 million. That was up 29%. But the operational data was softer. So 38 launches against an estimated 43. So they fell short a little bit versus 46 a year ago. Now they are putting a new rocket in the air, so that could be one of the reasons. But 480 5 metric tons to orbit versus an estimated 500. So they fell a little short there. So that's another reason why I think people are selling off the stock a little bit.
And Starship itself?
Well, Launch 13 was a real step forward. 20 Starlink V3 satellites were deployed. A Raptor restarted in space, the cleanest splashdown to date. The engineering progress is real, it's genuine, but the management gave no quantitative guidance on the commercial deliveries and when commercial deliveries will begin. So, and for a company valued radically on lowering the cost of reaching orbit, demonstrating progress is not the same thing as demonstrating economics. So that gap is where the risk is going to live. But if you look at Musk's track record in every case, he's closed the gap. So,
well, the balance sheet on this company, if you look at it, it appears bulletproof. Nearly $100 billion in cash and securities, $47.5 billion in backlog.
Yeah, I mean, it does look bulletproof, and it's in pretty good shape. But and this is the part I want most of your listeners to internalize because it applies far beyond one company. The question is never just how much cash a company has; it's where does the cash come from?
Okay, and where did it come from?
Well, almost none of it came from running the business. In the first 6 months of the year, operations generated $3.47 billion of cash. Investing activities consumed $34.49 billion. But the big deal here is the financing activities brought in over $100 billion, and that's $85.7 billion IPO, right? Plus 5 bond offerings totaling roughly $25 billion at coupons ranging from 5.3 to 6.5% that they have to pay interest on.
So, all right, the cash is investor money, right? Not earned money.
Yeah, exactly. So these are people who are willing to put money back into the company after the IPO. Investors, bond investors, people looking at the big picture, looking at the long term. Obviously, you have to lend at 6.5% is a lot, higher than what your treasury is right now, but not that much higher. So the liquidity exists because investors and bondholders chose to fund the mission, not because the business is currently self-sustaining. That's not a scandal. That's just a growth stage company. That's just what it looks like.
Okay. I'm looking at there's a share supply issue that's coming too, I would imagine.
Yeah, I mean, there is. And after the first earnings report, when you take a look at the big picture here, there's about 911.5 million shares that are going to come available to trade. So the lockup period is going to expire. By December, further lockup expirations could be more than 5 billion shares eligible. So, hopefully those shares get scooped up and absorbed by the market. But, people are looking at that as well and saying, what's the demands for those shares going to be at that time? So, there are going to be more shares coming available. That doesn't mean insiders will sell. It means artificial scarcity of the shares that exists right after the IPO will start to disappear. More available shares require more buyers to hold it at the same price. And that's not just supply and demand. It's just, you have an increase in supply. And you better hope the demand catches up to it.
And on valuation, the market cap has already come down hard, hasn't it?
Yeah, I mean, from the first day of the IPO price. But, I think, again, long term, it went public at roughly $2 trillion. Now it, dropped, I think, $1.6 trillion, but against expected 2026 revenues of about $38.6 billion, that's roughly 40 times sales. So, yeah, it's not a cheap stock, Gary. Let's look at the big picture there. All right. But I want to compare this to the other hyperscalers, so let's get into that really quick.
So let's widen the lens here a little bit because I don't think most people listening to this right now even own this stock directly, but you're telling me this pattern is everywhere, right?
Yeah, this is Microsoft, Amazon, Alphabet, and Meta. And what I did was I created a little chart because we're getting a little wordy here. I created a little chart, Gary, that shows the different spending, and I had to, I verified these numbers. So let's say Microsoft, so SpaceX was $15.83 billion. This is again $1.5 trillion company, very big company. The AI division was 15.83. X quarter ended was 18.37. But if you look at the Microsoft was 35 plus billion, 35.8. Amazon 54.21, Alphabet 44.9, Meta 31.5, $165.97 billion in spending by other four companies. So, I mean, it doesn't seem that they're that far apart from the other people who are building hyperscalers or building out the
So
AI.
really quick, if you put SpaceX next to them, is its spending actually unusual, or is it just doing what everybody else is doing?
Exactly. Look, this is a land grab. This is a land grab. It's a massive land grab. The data center build-out is a massive land grab. It's huge. Energy bottlenecks and employment bottlenecks, chip bottlenecks all over the place. But you start putting these things in space where energy is free by the sun. Mm-hmm. You're launching a satellite. NVIDIA and SpaceX just announced a deal that there'll be NVIDIA chips in those AI data centers. So I think it's going to be a very, very disruptive and I don't think, very, very disruptive thing. And why don't we end talking about the checklist review, by the way, because I know that's...
Yeah, because I only got about a minute and left before I got to wrap it up. People, if they start calling right now, first 5 callers, I mean, what can they get? It's like a $2,500 value.
Oh, easily. I mean, if you take a figure, it takes about 5 hours to put together. And, let's say my hourly fee was 10 hours to put together. My hourly was $250. It's an easy 10 hours worth of work. But what we find are details. We're looking for, by the way, we have this new form that has to be filled out for Social Security. If, God forbid, you become incapacitated, you need a form to get approved. And once you're approved, then you can fill out the other form that will which gives you the proper language so that your power of attorney actually works with Social Security. Right now, your power of attorney that you went to your lawyer for will not work with Social Security. Oh. It may not work with your bank. It may not work with your insurance company. How many other advisors are talking about this?
No one.
And how many other advisors are making sure you can get your money when you need it most, or really say, that's not my job, and it's it's on you to get your money when you need it most? So we're doing that. We're looking at home insurance. Remember that showing home insurance, making sure there's no major gaps in your coverage. So we are here doing all that hard, gritty work. And then, of course, we're going to find hidden fees, unnecessary taxes, high turnover, and things that it's costing you a fortune in your portfolio, eating away at your foundation. That's what we can potentially find, and that adds up to way more than $2,500. So, give me a call.
Financial Resources Group. They're based out of Glastonbury, Connecticut. You can find them online at frplan.com. frplan.com. But right now, call right now, 860-657-8380. One more time, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.